All right, perfect. All right, so I think we'll get started as people kind of roll in. Today, everyone who's attending, thank you for joining. Looking to have about a 45-ish minute presentation with some time to spare at the end for questions. Today, we're going to be talking about international investing and U.S. taxes, kind of the combination. We're lucky enough as WHVP to have on Stephen Miller, the president and CEO, founder of Stephen Miller and Company. They specialize in U.S. tax and especially on the international side when it comes to investing, doing business, kind of the full gambit. But I'll let Steve get in on that a little bit later when he gets into his presentation. What we're going to be talking about today, I want to kind of start off with a graph that I think shows the reason why we're here today. Why is international investing interesting? And then having the understanding of the taxes. So this is just the last 24-ish years, 25 really, of the purchasing power of the US dollar, not considering any other currencies. Just this is the value of your money over the last 25 years. So represents about a 60% drop in purchasing power. So your dollar is buying 60% less than before. This is, for me, shocking, and part of the reason you look for capital preservation with the right opportunities outside of the US. But we're going to get into that, and hopefully this presentation can be quite a full picture of what is entailed when it comes to having an account offshore. So why banking offshore? Then we're going to let Steve take over to talk about the key aspects of international investing for US taxpayers. And I'll talk a bit on international markets and what banking in Switzerland kind of looks like. Before I get into that, just a little bit quick on me. My name is Jess Roberson. I work at Weber Hartman Feihoff & Partners. We go by WHVP. I've been with the company for about 4.5 years now. Started at the bottom and have worked my way up to being a relationship manager. I had a lot of fun with our team. If I'm not in the office, I'm usually with my wife. As you can hear, I'm an American. I've got an American accent. I married a Swiss girl back in 2017 and moved to Switzerland. I'm usually in the mountains. That's the Lech Glacier where I'm standing, which is one of the largest glaciers still existing in Europe. And I used to play international rugby. I retired this year. I finished my career with the Swiss national rugby team. So just a little bit of insight into who I am, where I come from. I studied finance and international business. And have been in the wealth management area since the start of my career in finance. So why banking in Switzerland? Well, there is a big debt issue in the US, which most people are absolutely not unaware of, but it keeps climbing, right? I mean, this number is just up until 2023. We've surpassed 35 trillion now. So you can see the trend continues strongly up. I mean, now more than ever has been pretty recent with government shutdown and how strong this is. I love this Herbert Hoover quote, a little bit of pessimistic humor. Blessed are the young, for they shall inherit the national debt. But it should be a warning and a realistic picture. So how do you, why look outside of the US? Well, a debt problem is a big issue for a currency. Further to that, who's holding the national debt? Based on 2024, it's the public, investment funds, hedge funds. Now even, some recent enlightenment of who's holding treasury funds, it may be even more US held as opposed to foreign held through certain hedge funds off through the Cayman Islands and holding structures, which is investigation that's currently happening in the US. So there's just huge amounts of debt being held by the public, and even some of the offshore portion that was being held by the public seems to be being held by US companies, although that is still ongoing, so it's something to keep an eye on. Another great Benjamin Franklin quote, rather go to bed without dinner than to rise in debt. It's a principle for personal finance, but also I think government should take a look at it. Further, why the US dollar? Why think about other currencies that maybe are stable or strong against the US dollar? I mean, if we look at the global reserves, the US dollar is getting less and less of an allocation. It's actually from 2022, it's actually dropped another percent and a half from where the world is holding it. This is not a night and day, tomorrow 2 weeks from now kind of fall, but it is a long-term trend where there's less value placed on the US dollar as a reserve currency. And part of that is seeing this next slide of the purchasing power of the US dollar since its inception. Since there's currency being traded in the US, I mean, it's not total US dollar, but currency in the US. But you can see it's a significant fall. And if we look at the end of the graph, we can kind of see that 2007 to 2019 mark that looks pretty flat, but that graph I showed you beforehand really shows a picture of purchasing power loss in the US dollar. And are there other options, which I'm going to get into a little bit later. I'm going to talk about the Swiss franc, investing outside of the US dollar, and positioning, why that makes sense for a portion of your wealth. But this JP Morgan quote, gold is money, everything else is credit. To a certain extent, yeah, he's not wrong. But there's other currencies that don't have the high debt level that show stability against the US dollar over time. With that, Steve, I'm going to turn this over to you. Just let me know when I should switch the slides for you, and I'll let you talk about your expertise.
Okay. Well, the essence of my presentation is about building awareness, because in the international tax reporting arena, it's filled with minefields. And the idea is to have, professional tax advisors guiding you through the minefield so you don't step on one. So as we get in, I kind of listed 10 critical areas. As we move to the next slide, the next, we're looking at what are these big topics? What are these big issues that you want to be aware of? And can you switch the slide?
Oh, just a second, didn't pop over. There we go.
It wouldn't want to cooperate, of course, But really kind of picking these top 10, and that's, there's many more than that, and so many aspects that go beyond just what this discusses. But in building awareness, it may help the listener identify whether they have any issues or not, because many times it never crosses your mind that you've done something that needs reporting. So as we're looking through this, and especially from the investment standpoint, the type of investments you have outside the US can have less than wonderful consequences. So let's go to the next slide, which really, this is the first biggie. This is the one all my friends in the international tax area, the attorneys and accountants, really like to avoid wherever possible. The PFIC, the Passive Foreign Investment Company rules. And these were passed in law and have gone through various iterations since the 60s. But what creates a passive foreign investment company? Typically, the most obvious version is foreign mutual funds, exchange traded funds, other pooled kind of investments, and they can even if they're held within foreign pension plans, which is one of those unanticipated surprises that many people get into if they've worked overseas and they're in a pension scheme wherever it is, UK, Europe, Switzerland, that the investments within that may have a required PFIC reporting. And that's all done on this Form 8621. And there's various elections. It gets very complex and trying to parse it out. But the downside is if those elections aren't made timely, the income or gains could be converted from what you would normally think of as a capital gain and getting taxed as ordinary income. And that's very important, especially when you're in those higher brackets, 35, 37%, which really are more like 40% plus your state. And then there's also deferred interest charges that are a potential. So that looking at what your investments are offshore and where they are and is a first critical aspect of that. So on our next slide, good old FATCA, the Foreign Account Tax Compliance Act. This was passed a few years back and really brought onerous requirements on foreign financial institutions. And there was quite a bit of snapback from that because a lot of offshore banks won't touch anybody with a U.S. passport. They want nothing to do with it. As time has gone on, a number of banks have loosened up a little bit, or they have relationships with major corporations. So a lot of people working overseas as expatriates may be able to get these accounts open. But again, the FATCA really focuses on foreign financial investments. Now, we're not talking real estate. It really is that focus in that area because the government has determined that's where a lot of the offshore hiding of income and evading of U.S. taxes has come from. And the reporting on the 8938 is subject to certain thresholds. Part of it is, are you living here in the States or are you living offshore? And then, excuse me, your filing status, whether you're married or single. And once you've exceeded those, then you're required to file this information return. Now, in reality, an awful lot of what goes on the 8938 is also part of the FBAR, the Foreign Bank Account, the Foreign Financial Account reporting regime. But let me tell you, what I see as we're going through and looking at potential clients, oftentimes this form has never been considered, never thought about, questions weren't asked. And then getting out of trouble can be expensive. So on our next slide, we get right to what's often linked to that is the foreign bank account, the FBAR. Currently, the form number for all of the trivia buffs is the 114. And this is managed by FinCEN, the Financial Crimes Enforcement Network, which is part of the United States Treasury Department and not regulated or operated by the Internal Revenue Service. The problem is that, there's a lot of penalties. A lot of people used to ignore it. I remember, a couple 20 years ago, people just kind of poo-pooed it. They didn't think about it. They didn't really want to report it. It is just an information report. But the downside is if they catch you and you haven't filed it, the penalties can be quite massive. And it applies to U.S. persons. Now, that's the tax world. That definition is not just people, it's individuals, but corporations, limited liability companies, partnerships, trusts, you name it. Could even be not-for-profit if they, for some reason, had offshore accounts or generating charitable works offshore. Again, they look at many times it's confused. They think, oh, $10,000 account. No, it's an aggregate balance across any and all of your foreign financial accounts that exceed $10,000 US at any time during the year. So we've had cases where somebody goes down to Costa Rica, they buy a place, they wire down some money into a Costa Rican account, let's say $500,000. Well, they've got that FBAR requirement, even though the money may only be there 2 or 3 days. What the type of accounts often is missed is it's not just bank accounts. It's not checking or savings by themselves or CDs, but it includes securities accounts, commodities accounts, retirement and pension funds. Again, for those expatriates working offshore, or who did work offshore and still have those accounts there, they have, or very well may have, filing requirement. Any foreign life insurance where there's a cash value, or any pooled funds like any mutual funds, which, if you remember back to the PFIC comment, you don't really want to have. Another tricky part is the signature authority on accounts. We've had cases where, one example was some adult children here in the US who had been born in Mexico. The Mexican father had established Swiss accounts, and he never told the kids that they were named on the accounts and had signature authority. So we had to spend some time getting all that reporting caught up and problems resolved, and they didn't even know they had a problem. And I see that quite often. So if you're dealing with anybody where there's foreign relations, parents, grandparents, whatever, you want to clarify whether anybody's put your name on something you didn't know about. CFCs just stands for Controlled Foreign Corporation Ownership, and that can add complications and additional reporting, because if you're the CEO of 2 or 3 or however many foreign corporations, you may very well have signature authority over those foreign accounts, and you want to make sure that that's being reported so that you're not in trouble. The current penalty for each violation of the IRS catches you should have filed these, is $16,536 per violation. And that goes up every year with inflation. He started out originally at 10 grand. Now the non-willful says, I didn't know, somebody told me, I believed them, they were wrong, whatever. The willful violations is, well, you knew or certainly should have known and you continued to ignore it. Also, there's willful blindness. And those penalties start at 50% of the highest balance. We've seen cases where there was money offshore, had high balances, then it was withdrawn, and they still get penalized on the highest balance. And then, as I discussed earlier, that also leads to this problem in opening foreign accounts. A lot of the banks not wanting it because of the FATCA requirements. Now, on the next slide, we have double taxation. Typically, the income and capital gains may be taxed both by the foreign country and the US. A number of foreign countries don't tax capital gains. There's a number of countries that have no income tax. But keep in mind that as a US citizen or as a US resident alien, US company, you're subject to worldwide taxation. So if you have a whole bunch of gains from British Virgin Islands, Mauritius, Saudi Arabia, United Arab Emirates, where there's no income tax, you're still going to have to pay tax on that in the US. The punchline there is you won't have a foreign tax credit to offset that. You'll have single taxation. In those cases where you're dealing with countries with very high taxation, France, Sweden, and so forth, then you're generally going to run excess foreign tax credits that you probably will, it'll offset your US liability typically. And then another thing you always want to look at there is in relation to that country, whether it's Switzerland, France, Germany, etc., is there a treaty between the United States and that country? Because many times you can be collecting dividends from a particular country, and the flat withholding in most cases is 30% of the gross dividend. Treaty provisions, if you've filed the proper paperwork, will reduce that, sometimes to nothing, sometimes 5%, 10%, 15%. And one of the problems that people unexpectedly run into is where they haven't made those elections and applied for the lower rates of withholding. And I'll give you a perfect example. We had a case of one taxpayer citizen had UK accounts and never notified the UK that there was a reduced amount of withholding. So the UK bank withheld at one rate, and then the US would not give them a credit except to the extent of the treaty. So if it was withheld at 30%, the treaty said, well, it's 10%. They saw 20% of their money just disappear and was not creditable. All right, on the next slide. Penalties, penalties, and more penalties. This is, as I say, the carrot. You know, they talk about the carrot and the stick. The carrot is avoiding the penalties because the stick, the penalties, get very expensive very quickly. So the failure to file as a U.S. person any of your international information returns, most of those start at 10,000. Most of those start at 10,000, and then they really can get crazy. Failure to file the Form 5472 now is $25,000 per form. We had a new client come to us a few years ago and being audited by the, as I call them, the evil empire, the Internal Revenue Service. And they hadn't filed those forms, should have been 3 a year, for in excess of 15 years. And prior year penalties were 10 grand each, so it was 30,000 a year of what they were looking at. So it's something to be very aware of. That form is where there's a certain percentage of foreign ownership in a U.S. entity. Form 5471 is U.S. ownership of foreign corporations. Of course, the FBAR, we talked about that. The 8865 is where you have an interest in a foreign partnership. The 8938 is the FATCA reporting form. 926 is another form reporting contributions in excess of a certain amount into foreign corporations. Where that can drive you crazy is we see many of our high net worth clients invested in U.S. partnerships that in turn invest a great deal in offshore operations. So you'll have this Schedule K1 that's 97 pages and lists of all this foreign investment in offshore corporations. The Form 3520 relates to foreign trusts and also to gifts from non-resident aliens to U.S. persons. And that's one that we've been dealing quite a bit with lately because people are often unaware, but stop and think of all the people that have come into the U.S. and gotten citizenship or residency and their parents living in the mother country. Well, one of the standard tax planning strategies in many countries in Europe is as the parents get up close to older ages, they will gift their home to their children and retain kind of a life interest. They can live there for as long as they want to live in the home. And then upon their passing, it goes to the children. That makes perfect sense in the European tax side. The problem is on the US tax side, again, citizens and residents taxable on the worldwide income. When you're gifted something, you get a carryover basis. Well, that tax basis in the home may be very little. When it's sold, that could be a very significant gain, which would not be taxed in Europe. Where if it was inherited in the US, you get a stepped up basis, fair market value, date of death. That's one that catches people over and over. All right, next slide. We get into, all this complex record keeping. You own a home and you make improvements. How many people keep their receipts and tracking and proof of payment of what they've invested in it? When it comes to the offshore investments, it's the same story of determining a cost basis, what your capital gains are, what any relevant foreign taxes paid may be. The records often are not there. People didn't know, they didn't pay a lot of attention to it, they didn't think it'd be an issue. And we see that a great deal where they own another home or two offshore, or they have rental properties. Maybe they lived and worked overseas for a while, bought that home, came back, but continued to rent it. And of course, the PFIC reporting on those, a lot of the offshore investment companies are not very transparent. And it makes it very difficult to figure out what really went on within it when you're coming to this onerous US reporting. Next one, currency fluctuations. Well, of course, as we were discussing earlier, exchange rates are constantly moving, and that can create surprises in the investment world. You can have phantom gains or even non-deductible foreign exchange losses. I had a case, one client that some years ago, before a lot of the China money was expatriating from Hong Kong and going into Canadian real estate, especially Vancouver and Toronto, the US dollar is extremely strong against the Canadian dollar. They were able to pick up this beautiful property right there in Stanley Park in Vancouver. And so it was about 60 cents to the US dollar, the Canadian one. And Vancouver real estate hadn't been inflated. So they bought a property essentially about a 1.5 million US. And within a few years, with that influx of Hong Kong money, then you saw the value of it at around 8 million. And also then the dollar and the Canadian dollar at one point were virtually at par. When you start dealing with Canadian issues and US issues, you can have tremendous problems in the US estate tax, because Canada does not have an estate tax, but the change of the real estate from their name, one estate planner was attempting to move it into an LLC. That would have made that property immediately taxable. Fortunately, we got that stopped and it didn't happen. But there's dozens of mines there when you're dealing cross-border with our friends in Canada, which jokingly you could say still isn't the 51st state. But and I joke with my Canadian compatriots about that because we just kind of shake our head. On the foreign exchange rate at purchase is one number, foreign exchange rate at the date of sale. It can create either a foreign exchange gain, which is taxable, or a foreign exchange loss, which is not deductible. And then you've got your real. So you could have a loss on the sale of the property and have a foreign exchange gain. And so you're getting taxed when you really lost. And that's another one of those unpleasant surprises to be aware of. Next one, U.S. ownership of foreign entities. And this goes back to all this. This Form 5471 goes on for pages and pages and pages, depending on whether you're a complete control 100% owner or more than 50%, where it's a controlled foreign corporation. Various schedules of reporting. It's enough to make your head spin. And then what used to be in the old days, a lot of income could be left offshore, now typically gets repatriated. And then other forms, as I mentioned before, the Foreign Partnership Form 8865. I'm often surprised by the number of people that are in partnerships and didn't really think about it. Hey, it's a foreign partnership. It doesn't affect me. Yes, it does. And grantors, if you're a grantor of a foreign trust, we work with asset protection firms, law firms that set up trusts in foreign places, Cook Islands, Mauritius, et cetera, or even domiciled foreign trusts here in South Dakota, Nevada, et cetera. Or if you're a beneficiary of any foreign trust, you're probably going to be subject to this annual reporting of Form 3520 and the Form 3520A, which failure to do that has significant penalties. And then again, many people don't think about, well, I was working overseas and had money put in a foreign retirement account. And then they go, what do you mean I have to report that? The next slide, foreign financial institution resistance. So again, kind of rehashing the FATCA regulations really created an onerous reporting requirement. Most of these foreign banks not familiar with the U.S. system, not wanting to mess with this, and all the potential penalties that they would face, and just said all the U.S. accounts that they had, take a hike, so long, get out of here. Wouldn't accept any new U.S. persons, companies, etc. That has lightened up a bit. Some of the bigger institutions of more sophisticated, and they aggressively go through their account holders' information. Most of them, you have to be there in person to open the accounts and give them passports, etc. So that has limitations on your investment choices and your business operations. And we've seen a number of instances where you just set up your U.S. account and doing a lot of payments from the U.S. account. And, interestingly enough, some of the countries where the currency is essentially worthless, like Venezuela, Argentina, they'll use U.S. accounts to both get paid and pay their bills, even though they never set foot in the U.S. And finally, towards the end of these, the loss of passport. People often aren't aware that they're really in trouble with the IRS, or they've been ignoring these notices, and they have tax debt. Showing up at immigration control could get your passport taken, could be arrested. Passport applications could be denied. So now there's provisions in the law where State Department passport control is interfacing with the Internal Revenue Service. And then potential fixes, because while we talk about all the problems and penalties, there's ways to reduce or eliminate them. It varies by individual or company. The individuals, originally back in 2009, when UBS and other banks were going through a lot of the offshore hiding and tax evasion issues, we had the OVDP, the Overseas Voluntary Disclosure Program. That got changed and complicated, and really the only people going through that now are the ones that facing potential criminal charges. And that's done through sophisticated law firms. The more common one, the one we do a lot of, is the streamlined offshore filing procedures. The program's really kind of two of them. One for domestic taxpayers, people living here that have offshore accounts or used to work overseas. And then for the others whose domicile is offshore. But this program offers a way to get out of trouble, especially, you're non-willful, you didn't know, or you were told it wasn't important. Takes some time, takes a lot of work, and it's not cheap, but it can get you out of a lot of penalties and maybe avoid a lot of sleepless nights. And the real term of art on that one is the statement of non-willful conduct. That's what the IRS looks at carefully when they're processing it. And then the last one on the corporations and partnerships, et cetera, is, as I was mentioning, the Form 5472, 5471s, is the Delinquent International Information Reporting Submission Procedures. We just finished one of those for a company. You have about 3 years of amended returns. You're including these. You got to have your statement for reasonable cause. And that varies. It's another work of art. And there's quite a bit involved with it. I know the last one we filed was about 1.5 feet of paperwork submitted to the IRS. And it took about 10 months gathering all the information, fixing things. Many of them take less time than that. It just depends on how complex and what's missing. So that gives you a brief overview of whether, maybe some ideas of whether you're set and pretty or you've got some issues you need to explore.
Thanks, Steve. That's, I think, a really good overview in general. Really appreciate that. And I would say when you had on your potential fixes, being compliant from the beginning might be the best the best option there.
Yeah, I had a client used to call me Dr. No. He says, it's far easier to ask for forgiveness than it is for permission. And I said, yes, that's true, but it's also far more expensive.
Yeah, yeah. No, it's something, when we talk with our clients, it's always about working with the right partners. I think, your overview has been really good in showing obviously your competency throughout what every possibility could be offshore. And so while we today talk about the investment portfolio side, that's what I love you talking about PFICs is, finding that right partner to work with you who's not going to put in those investments that are going to cause you a headache. And then do your partners have the right partners that they can point you to, through this kind of collaboration with the right CPA who's going to be, giving you the right name of the person who's going to help them from the beginning, from the onset, make sure that they're reporting properly. And that's something, we've been in business since 1991 and always encouraged our clients, told them, look, make sure you're reporting your taxes. And we've never had to end service. We've always had banks through the crisis. You were talking about banks that had pushed clients out. We were always able to find partners because and not go have these issues as a company in general, because we always thought and told our clients, look, we're not here to hide money. We're here to add diversification to your portfolio and do it in a way that's not going to cause you issues.
So having that information is a huge time saver.
Yeah.
For the client.
Absolutely. I think it's really good. So now I'll jump on and try to get through mine here pretty quick, the little sections that I've got left. I want to talk about the market. We are obviously in Switzerland, and the banks we work with are in Liechtenstein and Switzerland. So the Swiss franc regime, we're definitely biased. There's other currencies, but just to give you a picture of what has the Swiss franc done against the US dollar over the past 25 years-ish, roughly. You can see that the US dollar has weakened against the Swiss franc by about 41%. If you talk about appreciation terms, a little bit higher. So just in that, as Steve was mentioning, those phantom gains that you have to be aware of, but that's capital preservation, right? So instead of having your money sitting in cash in US dollars, where it lost 60%, maybe it just lost 20% because you had it in Swiss francs just at the convertible rate. The further this drops back, the higher the savings were. So we can see that we're currently at around all-time lows. This is from October 8th, but right now the exchange rate is right around this today as well, actually. At about, so $1 US would get you about 80 Swiss at open. So that's just kind of the currency picture. You see the long-term trend of devaluation. This in the last 20 years. If we jump back to the last 10 years, similar trend. Almost always the low point is the low point in the future. The only exception being there back in 2012, it dipped below where it is today, but you can see it rebounded quite quickly. So if you miss that 2-week period, you're pretty much in the positive on your Swiss franc positions. So why global markets, right? The US exceptionalism. The U.S. markets have been, returning well, and this is a great, just kind of take a benchmark, the MSCI emerging markets outside of the U.S. versus the S&P 500. You can see that there's been clear outperformance in the last, decade of the U.S. markets in the orange, but you see that there are portions where the U.S. Actually underperforms, and we think that we're moving into that section a little bit more, where we're going to see this outperforming, and that's for a few factors. This is being one of them. When you look at the average PE ratio or price to earnings ratio of companies in these two indexes, the Europeans are about 20 to 30%. They've moved up a little bit this year, so about 20% below their long-term average. Why does that matter? The U.S. is well above their average at the moment. Valuations are very high in the U.S., And people say, okay, but that's a reason, American exceptionalism. This is why it matters. This form here shows the S&P. If you look at their forward price to earnings ratio, if you look on a 1-year context, kind of seems like you can buy anywhere and either it's not really going to affect your long-term performance. But if you look at the long term, and this green bar there, sorry, I should clarify that green bar is where current valuations are at the moment in the US and the S&P 500. But if you look at the long term, you can see clearly if I'm buying the better valued companies when looking at their price of the company that I'm paying for to their earnings, you well outperform those that have higher valuations. And so why does international investing come into that, especially as an American? If you're domiciled in the US, paying bills in the US, you come to this, which is it's a graph from a study done by Vanguard. When I first came to Switzerland, I was working in the wealth management industry, and I thought, okay, well, it doesn't really make sense to put your money outside in a foreign bank account, invest it directly outside of the markets. And I found this study where Vanguard looked at, okay, what about investing outside of the US as a US domiciled person? And you can actually reduce your volatility by 3 to 5% when you have 25 to 33% of your investable wealth not invested in the US, but invested abroad. Now, the caveat to this is this stability is using US dollar-based funds that are investing abroad. So you're still buying in US dollars. So there's no currency diversification here. When you look at the currency, if you're choosing stable currencies, can move it just a little bit further. So why Switzerland? Well, as a banking jurisdiction, first, the banking jurisdiction goes back to the 1500s when Switzerland started private banking for the aristocrats of Europe and even the globe. It's been militarily neutral since 1815 when they were internationally recognized. There's 240 banks, private banks, global banks that operate in Switzerland, which gives them a higher bank per population, so per person, than even the US. Switzerland is the world's leader in managing cross-border wealth, currently at about $9 trillion managed, and cross-border wealth is money that is being managed in the country, held in the country, where the owner of those assets don't live in Switzerland. They are a premier jurisdiction when it comes to integrity, education, professionalism. Their education system is always at the top. I mean, we're sitting in Zurich where there's ETH. It's the European equivalent of MIT. It's where Einstein studied. So there's a lot of innovation, a lot of professionalism that's kind of bred in at a very young age. And it sticks through that. I think further, there's strict federal laws and regulations around how intermediaries can act and how they can manage their clients, especially in a context like us. We're regulated by the SEC and by the Swiss market authorities. So you have two sets of regulations looking over you, which allows for that client really, I'd say the security of the client further. You have high GDP and low debt levels. I mean, Switzerland is a country of about 8 to 9 million people, a very strong surplus nation. It has years where it's a deficit, but the majority of the years are surplus nations, and they have low debt levels. So about 23 years ago, the Swiss population with direct democracy voted that the government have a debt brake as opposed to a debt ceiling. And a debt brake says, in Switzerland, it says you can only have, no matter what, you can only have no more than 44% debt to our gross domestic product, or how much our economy is making. So if the economy contracts and their debt percentage goes up, they have to reduce that. If their economy expands, they can expand their debt, but they have to do it within that debt brake. And it's led to a very stable, secure environment, and it's helped ensure that when the government is spending money, it's very well allocated. The pandemic response is a good example that saw inflation rise all over the world. Governments used debt to boost their economies when shutdowns went down. Switzerland did take on about 1.5%, 2% more in national debt, but they paid for all of the other stimulus that they gave out to the economy, they paid with their reserves that they had been putting aside because they had been surplusing and surplusing and surplusing. And so when Switzerland had high inflation, it reached its peak at about 3.4% and was down within its target range, which is 0 to 2%, within about 12 months. The US still hasn't hit it. Many of the countries are still struggling with inflation. Switzerland currently has 0% inflation. It's actually 0.1, 0.2%. But that's something that Switzerland always has to look at between light deflation and light inflation. But they have a very quick control on it because their central bank, the Swiss National Bank, only focuses on price stability. So everything else is up to the economy and is up to the government to look at. They're only focusing on the stability of the Swiss franc over time. This is why the Swiss franc has led to a safe haven currency, and why when you have the US dollar declining, if you're just trying to focus on stability, they're not even trying to look at how do we increase our value of our currency, because Switzerland is a manufacturing nation, although it be on the very high technical end of manufacturing. They don't want their currency to become too strong, but when you focus on stability and there's things unstable, you strengthen against that. Now, to say that, Steve, you were mentioning that there's other countries that their currencies don't mean much against US dollar, and that absolutely is the case. We're not here to spit doom and gloom, but really say, look, there's a key position for Americans with the right wealth profile, that investing abroad is going to add value, stability, capital preservation over time, and just making sure you're doing it in a correct and compliant manner. And that's why finding the banks is important. Knowing the right people, are the banks creating tax statements that you can turn over to someone like Steve, and he's going to see, I have all the information I need to fill everything out, making that way more seamless. Are they FATCA compliant? Which, as an American, if you're working outside of the US or investing, having a bank outside of the US, they have to be FATCA compliant.
It's all about diversification.
Yes, absolutely. And I think in the US, you can get these great funds that are ex-US, and for, I would say, a person starting to build their wealth, that's a great opportunity. But at a certain wealth level, you have the ability to go and build those portfolios outside of the US, where you get the expertise, not someone sitting in the US investing abroad, but someone sitting in that country who understands the laws, the business models, the accounting methods of those companies that you're investing in, understands the pulse, understands the currency, sees political movements, and is in the system. And that really adds that level of expertise that you're not going to get from a US advisor who maybe is buying an ADR, American depository receipt of a foreign company. You're not getting a currency then. Most US banks don't really do the other foreign currencies. Some might, but most don't. So having that specialist allows you to really build that portfolio out where you're not going to run into the PFIC issues that Steve Miller is talking about when you're working with someone who understands who you are. And so when it comes to investing, we're talking about equities directly at the markets, bonds, and precious metals, then being held in a Swiss or Liechtenstein bank account. And these kinds of things you have the ability to really build a nice portfolio in I would say, an efficient and tax compliant way, whether it's through an offshore trust that might be in the Cook Islands, and Nevis, and Jersey, you name it. A domestic trust can open up Swiss bank accounts. A private person, an individual retirement account can open a Swiss bank account through the self-directed method. You have to work with the U.S. administrator to ensure that the flow and the account itself stays tax deferred, but it's also possible. And these are things that add the flexibility of, okay, investing outside of the U.S., how can I do it? Is it possible? Where is your wealth structured? What makes the most sense? And making sure you have those right partners. So with this last quote, it's not about how much money you make, but how much money you keep, how hard it works for you, and how many generations you keep it for. For us, this last bit is very important because it's about protecting your legacy, the hard work that you've put in, your story. For us, it's about knowing the client and achieving something for the client that is not just in this time, but the next time, and obviously tailor making that portfolio to each client to ensure that it fits your desires and focuses for the future. With that, we can move on to questions. So the listeners, there's a Q&A tab that you can pop open and have a look at and type any questions you have. Steve, I have a question for you almost right away from my side that I'm curious. Before I ask it, these are our resources if you're interested. We have podcasts, we put out blogs every 2 weeks, and we have YouTube channels where we answer a lot of questions. But Steve, first I want to thank you for participating. It was really interesting, and I really enjoyed being able to hear from you.
Certainly, my pleasure.
The One Big Beautiful Bill Act was passed this year, and there was a clause in there talking about transactions leaving the U.S. and there being a remittance tax on that of 1%. Do you have any input into that on who's that going to affect come 2026 and who it's going to hit?
No, not at this point. The government shutdown, these IRS comments, revenue procedures, revenue rulings, et cetera, are held back. So in terms of how that's going to impact anybody, I don't have any insight at this time. Mm-hmm. There have been various countries where, Bangladesh is one that comes to mind, that where getting money out is extremely difficult. Mm-hmm. We haven't been that way. It's always been a pretty much a free-flowing kind of thing. But we've had a number of issues with money coming in and the banks being able to verify due to the anti-money laundering rules, whether or not it can come in. We've had some odd setups with ownership, kind of the people being from the wrong country, so to speak, and some other things. But it kind of comes back to the banking. And we've often had clients move to apps like Wise, which does international ACH transfers at lower cost than what the banks do, and so forth. But no, I haven't seen anything on that specifically.
What do you kind of have a gut feeling? Do you think it's just going to hit, these international SWIFT transfers? Do you have any kind of gut feeling from your experience where something like this might land?
No, I don't. It's capital will flow where it's best used. And if it becomes a problem of getting money out of the U.S. and incurring some kind of a fee, I suspect that's going to work against our economic interests.
Sure.
We'll just have to see. Many times when these guys in DC pass some law, you have the law of unintended consequences.
Sure.
They don't begin to anticipate some of the bad things that can happen. So we'll see.
All right. So the first question, we got a question. Thank you, Steve. We got a question from a participant that says, it seems reporting requirements can cost considerably for someone with half to $1 million. It doesn't seem feasible to invest outside of the United States. Is that a correct statement to make?
No, I would say not. Where it's expensive is when you should have been reporting. Most of these forms, other than your complex 5471, most of them, A, they're informational, and B, where you have good provider like you guys, all that information is laid out. It flows into the tax forms relatively smoothly. So, for example, in January, we will be going to all our clients with foreign bank accounts today. All right, send us the 12 monthly statements or the quarterly statements for the year. Just load those up. We quickly flow through it, find the high number, do the conversion. We can have the FBAR filed by the end of the month, even though they're really not due until October 15th. And that's a seamless process if everything's provided timely.
Yeah.
The same goes with the the 8938 really just ties in our tax software. We have the FBAR, and you click another button, say include this on the 8938. It's virtually no additional work. The other forms like 5471, that comes down to how good your foreign corporate books are. And it is more, but again, you're dealing with foreign corporation. Presumably, you're there to make money, invest, expand globally, whatever. Most of our clients that are doing that, they're, at least 5 million revenues offshore.
Yeah, and that's not so much to that point. That's
Yeah.
not much so what we're today necessarily talking about with the investment accounts. That's more of I've got a stake in a corporation that's been set up in, let's say, Germany, and how are that reporting going to go?
Yeah. Well,
Yeah,
if you're owning stock in German, French, Swiss, any of those corporations, that is not going to require any of that 5471 because A, they're publicly traded, and B, you're not going to have anywhere percentage ownership where that reporting falls in.
yeah,
So really, it just comes into, was there a foreign tax withholding? Was it done at the treaty rate? And then that in comes your dividend income. So when you're dealing with dividends from a foreign country, we have a treaty, those are qualified dividends subject to lower tax rates, 15
yeah,
or 20%.
yeah.
And then you get your foreign tax credit, which is, that's all straightforward, simple. It's not really adding great levels of complications to the investment. So,
Yeah, no, that's great. And that's, something that's important to us is, not being tax professionals, but having a good understanding of what are the banks that we partner with to help our clients with is knowing, okay, what are they have a tax statement at the end of the year? Does it have that highest amount in the year that's there? You
yeah,
know, does it have the reporting of anything withheld on dividends or coupon payments from those bonds? What tax jurisdictions are, and understanding laws to reclaim that, right? So even working with our banks of understanding, okay, and it's, as an example, in Switzerland, they have a 30% withholding tax against dividends.
yeah,
Knowing that I'm getting that at the year, but knowing that I have 3 years to reclaim those. So maybe with a $500,000 account, it makes sense to do that every 3 years. With a $5 million account, okay, that's every year I'm going to reclaim that because of the tax treaty. It's a little bit of paperwork, maybe $100 worth of expenses in terms of getting the right forms. I think it's the 6166 form from the U.S. That proves you're the U.S. tax resident essentially to the Swiss tax authorities. But then once it's reclaimed and put back, it's directly back into that investment account. And so, having that tax statement for us is one thing that's very important. Not just, obviously having those portfolio statements and those documentation, but also having that tax report form so that it's literally I get my tax form and I hand it to Steve and the information should be there. And that's something that we take very important so that exactly to this question, that it's not this huge, insane process that you're going to get hit with your CPA with.
yeah, yeah. It on its face, it looks complicated because the rules are, but when you're working with it all the time, it's
Yeah.
it's just part of the everyday operation.
Yeah, and I think that's why it's important to make sure you're working with the right partners. Again, at the end, does your CPA understand? I mean, we were chatting about this earlier today. How many CPAs understand the nature of what these foreign filings are? When I first moved out of the U.S., my cousin is certified or a CPA, and he said, "Oh, make sure you file your foreign bank account." Which was a great advice. I didn't know about it, but it was great that he told me. But this kind of fear from, okay, I know there's a law, but do I know that it's not such a big deal of just saying, hey, there's this thing that you should do. think about it. But the practice is, I mean, for many years, I filed my own taxes abroad, obviously with some advice, but the FBAR I filed pretty much every year by myself until I switched over to a international CPA. But yeah, it is something to always be aware of, and I think always go after the right professionals. Great. Well, that puts us at an hour, a little bit over. Steve, thank you so much for today. Really appreciate it. Looking forward to getting this edited out and put up online so that we can share the great information that you provided to the rest of the world.
Absolutely. Well, it's
Perfect.
my privilege and enjoyed it. I hope everybody got something valuable from it.
Yes, we did get some response that they said it was very informative and that they're thanking us. So.
Well, and we're in the tax planning season now, and as I tell people, tax return preparation is like arson investigation, and tax planning is like fire prevention.
That's great. That's great advice. I like that. All right. Thank you so much, and have a great day.
All right.